The following is a presentation of TFNN.
All right, welcome everybody. My name is Don Kaufman from ThinkorSwim from TD Ameritrade, and thank you guys for joining us for the Options Hour on what is seemingly, some volatility is back. And, we've been talking about this the last couple of weeks, but yeah, vol is definitely back. A lot to talk about today. And you happen to have kind of a tired Don Kaufman today. Up pretty late last night watching futures, and I was up pretty much the crack of dawn here this morning. Pretty much been sitting in my office since about 4:30 in the morning here, West Coast time, just taking a look at markets overall. I got to tell you, it looked a lot uglier last night. And as things, we've rallied back up a little bit. The VIX has backed off. But we are by no means out of the woods yet. Bonds are still showing the possibility of a big sell-off. Everybody, really, traders are on guard right now, as you can see, of course, in the VIX, the bonds. In fact, let's give you guys kind of a quick rundown of the markets here real quick. And again, this is a call-in show. It's about options. So give me a call at 877-927-6648. The other thing is I'm reading the chat room right now, so feel free to chat them in. I've also, I've taken a couple of emails in the last few sessions that I've done here. So, again, this is the Options Hour. If you've got option-related questions, if you've got options on futures, you want to talk about commodities here, you name it, I pretty much traded it out there. And, there's some interesting volatility going on. If you've got questions about it, give us a call here. Again, 877-927-6648. So, quick recap of where the markets are, like you guys are not watching. E-mini S&P 500 is down 20. NASDAQ futures down 41. Bonds up big. Notes up fairly large. Dow futures down about 195. Then we take a look at the VIX. The VIX is up just over 3 today, which is interesting because we haven't seen this kind of a pop on the VIX in quite a while. In fact, this morning, the VIX actually opened up over 4 and change. And if you think about that, if you saw a $20 underlying jump by $4, percentage-wise, these are drastic moves in the implied volatility. When you really start to think about what implied vol is, you start to realize that the implied volatility, which is the risk in the entire S&P 500, has moved that far, that quickly. It starts to kind of wake you up, like a 20% move in implied volatility. It should wake you up because the 20% move in the entire S&P 500, obviously risk has come back to the marketplace. Other stuff that we always look at here whenever I talk is, of course, when I talk about bonds, you can look at bond futures, but you can also look at TLT and TBT. And, of course, what we're seeing is the flight to quality. When I say a flight to quality, people are buying bonds. When you buy bonds, that literally forces interest rates back down. So there's an inverse relationship, of course, between bonds and interest rates. And you're seeing people with this flight to quality, again, the bonds being the flight to quality here, buying up bonds. And although we're not as far extended on the bonds as we saw earlier today at the open, we're not that far off it. So there still seems to be quite the large flight to quality in those bonds. And, hey, I'm telling you right now, from here, you've just got to keep your helmet on because we could go anywhere right now. A lot of us that are watching order flow throughout the day, I'm actually chatting here on Instant Messenger with a guy by the name of Frank Walsh, who started trading on the floor in 76. I've been back and forth with Tom Sosnoff. In fact, I talked to Tom Sosnoff. It was 10 o'clock, West Coast time. Sosnoff's still up. It's midnight, Central Standard Time in Chicago where he's at. And I said, you need to go to bed. And he goes, no chance. No chance of Tom going to bed anytime soon. And that's because last night these ES futures were down about 36 when we were talking last night. NASDAQ futures are actually down about in the mid-50s. So, something to talk about today. Anyway, with that, feel free as we go on here. I see some questions coming in, which is fantastic, but feel free to also give me a call, 877-927-6648. We'll take our first caller today, Richard from Michigan, learning about options. So you there, Richard?
I'm here.
Oh, excellent, excellent. What do you got for us today?
Well, I'm really not that familiar with options. I trade every day in the stock market, but I've just been buying and selling equities and a few ETFs.
So
I need to figure out a strategy to do puts and calls, like covered calls or.
Sure, and that's all where it starts. But you got to broaden your horizon. Only from this perspective, I was at a big trade show in New York just a couple of weeks ago, and we had a lot of people coming up to the ThinkorSwim TD Ameritrade booth, and they said the exact same thing you just said to me. They said, hey, I trade stock. I'm not that interested in options. And, it's been our belief for, a long, long time in this business that to fully understand even stocks, you've got to have some knowledge of options, regardless if you're going to trade them or not, because understanding implied volatility is understanding the risk, okay, that's pricing options, and ultimately, okay, implied volatility is really defining how far a stock can move within a given period of time. And we think that's just critical. So, you're right along the lines that I would actually agree with, you want to learn to sell a covered call to collect a little premium, probably learn about some vertical spreads. There's a lot of stuff that you guys can read online today, for free. You can go online, you can find out what a vertical spread is. You can even go to ThinkorSwim.com. I mean, there's tons of education on ThinkorSwim.com. We've got chat archives, all kinds of stuff there. But, just don't get too discouraged, because the learning curve, it's not like an overnight thing. You don't want to just go out and run out and trade an option, after reading a couple of books and so forth. My belief is options trading comes much more down to criteria than it is an understanding of options. That is, you got to know which options to trade. You got to know how far in or out of the money to go. Again, what expiration cycle, and that's kind of what really separates a lot of the option stuff that you can find online out there. So, what else are you looking to do with them?
Well, it's really hard for me to formulate questions because I know so little about it.
No, it's all right. That's all right. Well, I'll tell you what, good starting place. Also go to the CBOE.com, Chicago Board Options Exchange.com. Check it out. Also, TD Ameritrade happens to own Invest Tools, one of the largest stock market education firms in the world. They've got option classes. I mean, some of them are paid for. It really depends. Do you want to pay for some classes going through them, or do you want to basically just, cut the learning curve and jump right in? And some of those paid classes can help you. I mean, they'll be great. And that's really the starting point, for a lot of you guys listening to this talk today, is that you got to get started somewhere just to cut down the learning curve. And part of that is hop online. I mean, Google what a vertical spread is. There'll be 100 different sites that come up. But some good free stuff out there also. You have the Options Industry Council, which is the OIC, Chicago Board Options Exchange, ThinkorSwim.com's got a tremendous amount of education. And if you guys are looking to sit in paid classes or online classes, there are also Invest Tools from TD Ameritrade. So, check all those different venues out.
You have to be a client of TD Ameritrade's to go into that?
No. If you want, just go to ThinkorSwim.com. There's tons of free education directly on the main website. You can even download ThinkorSwim software. It'll give you delayed quotes, but you can download ThinkorSwim software and play with it. Forever. It'll just give you delayed quotes on there, and so you've got all the technology pretty much. And it'll help you through the learning curve considerably. No doubt. So I hope that helps you out a little bit, Richard. And if you got any more questions, fire away.
Okay. Well, thank you.
Yeah. Thank you very much. Thanks for calling in. All right. So that's really I love calls like that also because there's probably a lot of people, and I always take this for granted. There's probably a lot of people listening that just are an options trader, and you're listening to an options hour. And sometimes I talk about stocks, options, futures. Ultimately, everything you trade today, it's seamless. When I say it's seamless, whether you trade a stock, an option, a future, even currencies, it doesn't matter. And really, all of those products today are given to you on one front-end piece of technology. When we were originally building ThinkorSwim, this is going back to like 2000, 2001 when we were first, releasing ThinkorSwim. That was kind of our big premise, was there wasn't anything in the retail world that would allow you to trade stocks, options, futures, currencies seamlessly. I mean, some of those products like currencies wasn't even heard of, 10, 12 years ago. Today, everything is, one click of a mouse. Fills are in less than, a hundredth of a second today. And, it's amazing. If something delays, like if your order gets delayed for 1 second, you're typically on the phone, you're like, I can't believe my order got delayed for 1 second. Boy, has the business changed. 10 years ago, when there wasn't a lot of, a lot of choices in terms of brokerage firms, you were happy if you got a fill in 15 minutes. All right? So anyway, just taking a look at some of the questions coming up in the chat room, and also feel free to give me a call. The number is 877-927-6648. Ooh, one of the questions, all right, so somebody's asking me a pretty big directional-related question, and the directionally related question is this. If I think this is a short-term 3 to 4 week bottom in the spider, what vertical spread would you put on? You know what? If you do think this is a short-term bottom here that we're going to create, and the honest truth is, in a market like we're in right now, with the VIX up, it's $3 and change. And I want you guys to understand the VIX has been climbing. So the VIX opened up big. We are opened up about $4 and change. That's how far the VIX was up. And we backed off considerably after the open. Then the VIX was only up like $2 and change. And it has been steadily climbing. And this kind of order flow is making me a little bit nervous, only because the bonds are reacting the exact same way. And basically what you're looking at right now is when I say looking at order flow, you're starting to see that traders are positioning themselves from a possible big sell-off here coming, okay? Vice versa, if they're not positioning themselves for a big sell-off, okay, there is a hell of a lot of fear. So regardless, position yourself correctly here coming towards the close, because, we could be rocking again. There's also decent volume today. We haven't seen this kind of volume in a long time. So anyway, if you think this is a kind of a short-term bottom here, looking for a vertical spread and looking for a bounce up, there's a couple different things you can do. Immediately, I open up the April options here. So I've gone to the SPY, opened up the April options, and this client, I think it's Chris G in the chat room, which says, short-term bottom here on the spiders, what would you put on? You got basically two choices. Well, basically the two choices are you could sell an out-of-the-money put spread, okay? But the reality is, if I go, before I even click on this put spread, I know something. With fear today, the skew inside the put spread, okay, is going to be pretty drastic. So put spreads are not going to be trading that advantageous. But let's take a look. We're going to look at selling the 126, 124 put spread. So I simply right-click, go to sell, down to vertical, 126, 124 put spread for about a 60-cent credit. It's not spectacular, so it's a $2 wide spread, 60-cent credit's got about $1.40 a risk. But the most you can make on that thing is about 60 cents. Now, the nice thing about this spread is it's got a relatively high probability of success associated with it because you're selling an out-of-the-money put. Okay, all right. With that, let's give you another idea here to give you a little bit more upside. Probabilities being not quite as good, but again, a little bit more upside. So everything in options trading is a trade-off here. And in this particular case, you'll see the spiders are currently trading for 127.85. I'm going to go ahead and right-click directly on the 126s and simply go to buy vertical. And we're going to be looking at buying a vertical spread. Let's take a look at this vertical spread right here. This is a 126, 130 vertical spread. So it's a $4 vertical spread, about a $2.26 debit. All right, you can even bump these strikes out here all the way up to like a 131 in this case. About a $5 wide vertical spread for about $2.68, $2.70. This particular spread has only about a 50-50 shot of success. The spread itself is already in the money, okay, by what? About $1.95 right now. The spread's in the money by about $1.95 here. Okay, so whoops, got another screen that just popped up over here. So again, the spread's in the money by about $1.95, and yet the actual spread itself only costs $2.70. So there's not very much extrinsic premium that you're paying for in here. So one thing you want to keep away from when utilizing vertical spreads is buying extrinsic or time value. So really, that's ultimately what we want to kind of keep in mind here. And those are, just two quick ideas for buying spreads. The other thing is, if you've got some guts out there, you could definitely, Chris, you might not like this, you could just get long some futures contracts. But, getting long futures contracts right now, oh, man, you got to have a stomach for that, because we could sell off another 30 or 40 easily at this level here. So this is one day that you're never going to hear me say with the VIX up $3 and change. You want to step your toe in the big water, in the water right now. You might get that toe lopped off putting your toe into the water right now, because this could get ugly by the end of the day. And if not by the end of the day, there is too much information that is not clear yet as to what's going to disseminate, of course, out of Japan and out of the Middle East. When I look at this market right now, it's anybody's best guess. I don't care how many technical levels you want to look at. Okay, personally, I'm not a technical trader, but I don't care how many technical levels that you want to look at. In the end, what's basically you're looking at is what's going on in the Mideast versus what's going on over in Japan. Too much information to disseminate out. On a day-to-day basis, it's pretty much order flow is going to rule here, and you're going to find that out in short order here. So keep that in mind. I know everybody's going to say, if we rally back up, it was because of a technical level. No, we rally back up, it's because they figured out that obviously the information being disseminated, might not be as severe as initially thought. And last night, it got ugly. It really got ugly at points last night. So with that, okay, give us a call. I'm just looking at, so people are saying it doesn't have to be on today, just when you think a bottom is in. So, if you think a bottom is in, there's no problem whatsoever about selling out of the money put spread. And I like it. Selling out of the money put spread if you think a bottom is in gives you a little bit of a higher probability of success. The other thing is, you got to think about this. How about you're thinking about getting long something like the spiders? If you want to own the spiders, you could go out and, for instance, sell a put. You look at like these April, for instance, 124 puts. Now, if you thought a bottom was in right now, it's not a bad idea to sell premium on a day where the VIX is up $3 and change. You're getting a tremendous pump of volatility here. So all of a sudden, these options last night, weren't trading anywhere near $2.13. These options last night were trading with volatility down, $3 and about, I've put the volatility down here about 320. So last night, these options would only trade for about $1.70. Today they're trading for $2.14. Pretty drastic difference here. What I'm doing is just utilizing a theoretical pricing calculator to ascertain what these options, the 124 puts in April, would be trading for if volatility was not up $3 and change today. And that's basically what I've done with the theoretical pricing calculator built onto the ThinkorSwim platform there. So with that, simply hit reset. And again, this is a call-in show. Definitely taking a couple of questions in the chat room as well. I'll keep up as best I can today. But give us a call, 877-927-6648. Oh, we've got another question here. All right, Paul, looks like from Massachusetts, a condor trade. Are you there, Paul?
I am indeed, yes. Thanks a lot.
Yeah, how you doing?
I'm doing great, thank you. I'm looking at a condor trade that was posted in one of the rooms in ThinkorSwim, talking about April, Russells, with indicating a maximum loss of 0, but a maximum gain of substantial amounts. I guess, of course, they're using substantial quantities when they're putting this on. But are these kind of lottery ticket trades when you're looking at a condor trade like this, and where they're looking at, I guess they're all puts that they're buying and selling? And,
okay, so I'm just going to guess onto what the trade is right now,
sure,
without even having the strikes. So what they're probably talking about, if there's no risk in the trade and the payout could be huge,
yes,
it's probably a form of what they call either a broken condor or a broken wing butterfly. And what that basically means, though, is that there is heavy amounts of embedded risk in that spread.
Okay?
So basically, you can lose on that trade if the market moves adversely to you. So what they're doing is they're building a vertical spread into, for example, a butterfly. And I'll kind of show you an example of one here real quick. Are you on the screen show there with me there, Paul?
I am.
All right, so if I right-click, like I'm just going to pick the 770 strike here on the rut.
Yeah.
I'll right-click on it. I'll go to buy. I'll go down to, in this example, I'll use a butterfly. Condors and butterflies are pretty much one and the same. The condors just don't share a central strike. This should make it a lot easier. So if you take a look at the butterfly that I pulled up a 775, 770, 765 B-fly, and it's really showing about a 5-cent debit on here. So you're like, wow, this thing is really inexpensive. So the higher the implied volatility, okay, the cheaper the butterfly is actually going to be. So that's a straight butterfly. And you just saw the butterfly just changed to 20, 25 cents, which is much more realistic. The bids and offers are really swinging around pretty quick right now in this volatility today. But
sure.
So this particular butterfly, really, it should be it's even more probably than 25 cents. You'll see the market is 25 cents at $1.10. Realistically, if you were trying to fill this butterfly, my guess is you're going to pay up somewhere in the neighborhood of 40 or even 50 cents.
Sure.
Let's say you pay 50 cents for this butterfly. It's a $5 wide butterfly. That defines the probability of success in this particular trade. Okay, meaning that the cost of the butterfly defines the probability of success. An easy way to put that is if you went into the spiders and you bought a $1 wide butterfly for 10 cents, that means that butterfly approximately has a 10% chance, okay, of making some money. I mean, that's how simple the math is behind it. But what a lot of people have engineered is what they call like a broken wing butterfly, and that's simply the 775, 770, and they'll break the wing from the 765, for instance, down to the 760s.
Sure.
What that is sometimes you can even create a butterfly for a credit. But what's missed is that there is a $5 wide vertical spread embedded in this. There's going to be pretty considerable margin associated with it, too. A one-contract trade over here looks like we got a max loss of $360. The max profit looks great, $640. The only reality is there's like almost no chance that you're going to make $640 on it, because to make $640, you got to fall right on 7070, the center of the 770 strike, on expiration day of April. You know, the stars basically all have to align.
Okay.
So it's tough to make the full amount. Be careful, though, of embedding a vertical spread if you don't want to ensue that much risk. So there is no strategy that you're going to find that literally has zero risk and a big payout. So somewhere in that, you're going to have that embedded vertical spread. And if you're comfortable with it, hey, go to town. I mean, personally, if I embed a vertical spread, all right, or sell a vertical spread, I'm going to want to get paid for it. You know, I don't like doing a trade for free that has risk. To me, that doesn't make sense, because still the probability of the trade, the butterfly hitting, is still very low.
Yeah.
And you have risk on top of it.
Okay.
So, I'd err on the side of caution on a couple of those.
Well, their pricing was quite a ways out. It was the 830, 835 put, buying and selling, and the 840, 845 puts, selling and buying. So
they're actually using in the money?
I really don't know if they're... Yeah, that's true. Yeah, indeed, they are in the money. And it just looked like it did seem like you're shooting a basketball through a hoop to get to a certain price point at a certain time, like you just mentioned here.
Yeah, the problem with that trade is if we don't get to that certain price point, it's a losing trade.
Yep.
The other thing is the spreads of in-the-money options on the rut will kill you. You'll never get it filled at a decent price. You'll see that, like, it's pretty interesting to look at this, but if you look at the out-of-the-money options, you'll see a 50-cent wide market on the Russell.
Okay.
If you start to look deeper in the money, you'll see, like, dollar-wide markets. And you're like, that's just not fair. Why are they doing that? It's because they can.
Okay, very good.
So, yeah, definitely would be careful on that. Now, the reason I'm guessing they're using the rut is because there is a European-style option. There's no early exercise or assignment. I would never try to pull that off in an American-style option, because they will put you stock early.
I see.
So, yeah, keep that in mind for sure.
Great to know.
Yeah. Got any other questions for me, Paul?
That covers it for now. I appreciate your help on it.
Yeah, thanks a lot. And feel free to call back in sometime.
Take care.
All right. Good talking to you. All right, so another great call. With that, give us a call here, 877-927-6648. We will answer your option questions. It's kind of brutal. Nobody wants to call in because every single question that comes in, I'm like, I don't know if I do that one. One thing about options trading, keep it simple. Butterflies are fine. Vertical spreads are fine. Listen, butterflies are a form of vertical spreads. Embedding vertical spreads into butterflies is fine. It ties up a little bit of margin. When you start to utilize in-the-money options, though, I'm never really an advocate of doing too many strategies utilizing in-the-money options because the bid-offer spreads start to widen out. People get themselves into trouble, too, with exercise or assignment of in-the-money options. The bottom line is if you buy an in-the-money option, even if you buy an in-the-money option and you forget about it on expiration day, the option clearing corp will exercise your rights, okay? As an option trader, they'll exercise your rights, and they will buy you that stock. And then, of course, on Monday morning, we call you and they say, hey, you have a margin call. That's never a fun conversation to have with somebody. Anyway, with that, give me a call again, 877-927-6648. We want to answer your questions, stocks, options, futures, you name it. This is the options hour. Markets really haven't moved since we started talking about 25 minutes ago. ES futures still down 20, NASDAQ futures still down 40, VIX up 315, been creeping up since it actually opened up 4 and change, dropped off into the 2 handle, and it's starting to creep back up there. So keep a good eye on that one as we go through. So again, feel free to chat in your questions here. And we're going to take another caller here in just a second. But again, give us a call, 877-927-6648. I believe we have Jim on the line. Jim from Palm Harbor. You there, Jim?
Hey, Don. How are you doing, Don?
Good. We've talked a couple times, haven't we?
Yes, we have. Actually wanted to talk to you about adjusting let's talk about the SPY. I bought the April 129.
All right.
10 lot.
We're pulling up. All right. So the April 129 calls, I take it? Or puts?
Right. No, these are the puts for 2.9.
Okay. You know what? That's a good thing.
The trade worked against me, so I sold March 128s to collect 3/4.
Oh, yeah. Yeah, okay. I remember we were talking about this. You were going to buy a slightly out-of-the-money option, let the market stink, and then sell in a further out-of-the-money option?
Right, but it worked against me first. So what it did was when we had that up move, I ended up selling the March 128s for 3/4.
Okay.
Didn't think we'd have a move that quick. So I'm basically now back to break even with this big move like this. Do you end up adjusting it, or just let it go away, collect $100, and go on to the next trade?
Yeah, you know what? When you legging, I remember talking to you about this too. Whenever I have legged positions, I think I've told you this. For every trade I've ever legged, had I not legged the position, I probably would have been better off, which is the exact same position you're in. And once in a while, the position that you're in, like right now, if you can get out of a broken position alive, it might be worthwhile to do it. Because it doesn't sound like you stand to benefit very much from holding this particular spread.
If we go back and close we're right at 128. So if we would just tread water for a day, that premium will evaporate on the March 128s, and the 129s. Maybe I'll collect $300 or $400.
Right.
That's just
right.
Just a timing question.
The question is it worth the risk? How much do you have a risk on the spread?
Well, I think even if we have a counter trend bounce to fill this gap, I think we're still heading lower. But
that's
the trade on, and with April, we've got plenty of time.
Right, absolutely. No, I agree with you. But I'm looking at the risk in that spread versus what you can possibly make. And again, the other thing you can do is just close a couple contracts. Sit tight with a couple. So don't try to second guess yourself on it. If you still like the spread, keep it. If you still like it and you're like, I got a lot of risk on, close half this trade. And if you think we're going to bounce, which we very well could, bail out now. Take it for what it's worth and bail out of it right now. This is really just 100% at this point, like a judgment call of where you think the markets are going to go, and it's tough right now. It's really tough.
It's really tough because it's Tuesday. We still have a lot of time premium still left in those options. And but we'll see. We'll see. I still think we have another rug pull coming this afternoon, or at least they're going to give it an attempt.
Oh yeah, you know what? I have tendency to agree with you. I think they're gonna try to hit this coming right up to the close. I really do, and it's the only reason I'm saying that is because that VIX is held up nicely, and the bonds for some reason right now the bonds are just saying like it's positioned for a big down move, And we haven't seen a bond move like this in quite a long time, where you know that there's serious amounts of capital moving when bonds are up this far. So, yeah, I'm definitely a little nervous. But, if you can make a couple $100 by day's end with a big sell-off, it might be worth it.
I'm looking at a trade, just looking pure risk capital on a March TZA.
Yeah.
I'm looking at a long March 45 call, short a March 46.
Yep.
If I can pull this off for a $25 credit, the maximum I would make would be $2.
Sure.
Or 75 cents. So it's a 3-to-1. Do you think I should be looking at something? I mean, the max risk on a 10 contract is only $250.
Oh, yeah. I mean, just taking a shot for a couple of days, right?
Right.
There's nothing wrong with
it. Is that the kind of trade you look at just out of the money here?
I'm sorry?
Are those the kind of trades that you look at, or are you looking more on an April selling premium?
All right. So you're right. So most of the time, 9 out of 10 times when I trade, I do sell out of the money premium, okay? However, if I'm looking for like a quick directional play in something like a TZA for just literally a few days, like you're talking about. First of all, TZA, the bid-offer spreads, yeah, they're kind of wide. But if I just wanted a quick directional play on this thing, what you can actually do is buy a slightly in-the-money spread to basically lower the extrinsic premium in there. All right, so for the most part, I can look at, buying a put spread here. Are you looking for the pullback here, or are you looking for this thing to keep going up?
Well, I'm looking for a move on TZA. We had a big move up this morning, all the way close to 45.
Right.
On the open. So I'm looking, if we get that move again towards 45, if I can go from 250 to 500, I'll go ahead and on 10 contracts. If you look at something interesting right now, just for a couple of days, I just want to make a quick point here. On TZA, you can buy a 43 call, which is obviously in the money, and sell a 44 call, and the entire trade will cost you 46, 47, maybe 50 cents because the spreads are a little wide on here. Okay.
And what's interesting about that is the spread itself, okay, is in the money already by 57 cents. So you're literally buying this spread for what is under intrinsic value. And the spread itself has got better at this point than a 50-50 shot. And that's a little shot that you might be able to take pretty effectively here for the next day or two. So always look to that, because what this spread is doing by buying a slightly in-the-money call spread is it's not costing you any time value whatsoever. Basically, those 43 calls already have 56 cents of intrinsic value. All right, so and the whole spread's only going to cost you, even if you had to pay up for this thing, it's only going to cost you 50 cents at max to get into it. And that's the play I would actually look for. And you're like, well, I can only make 50 cents on this damn thing. But you're not paying any extrinsic premium for it.
Right. So you're talking 2-to-1 then?
Yeah, this is about a 1-to-1. It's about risk a dollar to make a dollar, because the 50 cents, it's a dollar-wide spread that you're paying 50 cents for, so it's basically risk 50 cents to be able to make 50 cents.
Okay.
What's actually interesting, though, is you do have slightly over a 50% probability of success in this trade, because we're already in the money, all right, by more than what you're paying for the spread.
Okay.
Yeah.
I'll play with the numbers. Thanks for your help. Thanks for your insight.
All right. Thanks a lot, Jim.
Have a great one. Bye.
So, excellent. Okay. So, again, give us a call. Lots of stuff to talk about today. Markets are definitely moving. I like it. You got some people looking for a rebound here, some people looking for a bigger sell-off here. That's what makes a market, and it really does. I mean, we've had, a couple of callers here already. One guy's bullish, one guy's looking for a bounce, obviously. The other guy's like, we're definitely going to sell off by the end of the day. I'll tell you what, shorter term, I have absolutely no idea where I think we're even headed tomorrow. I mean, this is a weird week. We're coming into an option expiration. All right, you got Netflix for some ungodly reason up $15 today. I know there's news pending on it over here, news out on it. So Netflix is the only thing that's kind of bucking the trend, yet Apple's getting hit. A lot of your big bellwethers are getting hit. Gold getting crushed down today. That's a big move in gold, so some of your commodity stocks are getting hit big. Oil, of course, also getting clobbered a bit today. Where is my oil up here today? Do I have my oil quote up here? Yeah. Anyway, with that, here's my oil down $2.42. Give us a call as we go through. Oh, you know what? I got another question, and I promise I'm going to get to your TLT question. Dan from New York in the chat room is asking a question about TLT. With that, the rest of you guys, give me a call, 877-927-6648. This is a call-in show. So, he's asking basically about, Dan is asking about thoughts on April TLT calls. All right, the good, the bad, and the ugly. First of all, you want to basically take a position here within the TLT. If you're buying these out-of-the-money calls, okay, and I assume you're talking about buying calls in the TLT, let's just take a look at some of the out-of-the-money calls in the TLT for April. Obviously, if you're buying the TLT calls, you're bullish in TLT, which means, inversely, you're kind of bearish in the market. Are you really bearish in the market? Because that's something that I think a lot of people, don't really look at. You could go out and buy calls in the TLT, but what's another trade that can basically produce the exact same thing? Well, what could produce the exact same thing is simply you could get short the markets. You could get short the S&P E-minis. You could go out and get short the spiders out there, and it's a very similar trade. The one thing you do have to watch on the TLT whenever you're trading these bonds, bond funds, or bond ETF funds out here, you got to watch a guy by the name of Ben Bernanke because he'll kill you. I'm actually in the inverse position here myself. I've got some positions right now on TBT, which is the double inverse of the TLT. So let's just get back to the nuts and bolts, though, of the option itself. First of all, what I'm going to do is just change one of my information layouts here on ThinkorSwim, and I'm going to change it over to what's called probability of expiring. And that's probability of an option being in the money by 1 penny or more come expiration. And ultimately, buying out-of-the-money options can make you money, and it can make you decent amounts of money. The reality, though, of buying out-of-the-money options, the probability of you making money, it's not very good, okay? When you take a look at for instance, the April 94 calls, I'm not saying you're not going to be profitable, but for you to be profitable, we'd have to be at 94 plus basically the 90-some-odd cents you paid for this. Bottom line is we got to be about $95 for you to be able to make or break even on this trade. Okay, there's only a 25% chance of us closing above $95 or the 95 strike by 31 days from now, which is, of course, the April expiration. Probability of expiring is based on these option prices. It's based on the implied volatility that derives the option price. So ultimately, do you want to go out and do you want to buy something that only has a 25% chance of getting your money back? Now, it's not to say we could explode to the upside. Okay, meaning that, hey, this underlying could go from $92 all the way to $100, all right? But still, it's the probability is not that great of it happening. So when you're in this business, if you want to survive longer term, many traders switch from lower probability buying out of the money options to higher probability trades, which is typically not buying options, but selling out of the money premium or selling some premium in a defined risk manner. Now, it doesn't matter if I agree with your trade or not. It doesn't matter. I don't care that you're bullish on TLT and I might be bearish on it. That doesn't matter. What matters is that you can, confidently go out and be able to put trades on this thing that have higher probabilities. You might want to go out and look at selling an out of the money put spread, like selling a 91.89 put spread out there, and you're not going to collect but 60 cents on this spread, but it's not half bad. Collect 60 cents, but the trade itself has over a 65% chance, okay, of making money there. So, hey, any of these trades are totally viable. The other thing you could do is, again, buying a slightly in-the-money, okay, call spread if you're bullish. Buy a vertical call spread that's slightly in the money. The odds of one of these things making money, it's pretty interesting. Here's the most simplistic way to show you. The 92 calls that I'm buying here, I'm buying a 92-93 spread in this case. The 92 calls are already in April in the money by 61 cents. Yet I can buy the 92-93 vertical spread for a 48-cent debit. So you're literally buying a $1 wide spread for under the intrinsic value. Intrinsic value means the real value of the 92 call. And it becomes interesting to be able to do that. So keep this kind of stuff in mind. You could also manipulate the spread to the 91, maybe 94. Take a look at this, the 91-94 spread. Ooh, that's interesting. Why is it interesting? Because this spread, it's a $3 wide spread for a $1.45 debit, and the spread itself is already in the money by $1.61, and yet you only have to pay $1.45 for it. You got to think logically. This spread has about a 50-50 shot of making money. Okay, but this spread is, theoretically speaking, it's the same thing as getting long the stock, yet you never have to use a stop order. The most you can possibly lose is the debit for the spread. That's what I never understood about traders. They go out there and they buy the TLT. They buy the TLT and they put a stop order. Where do you put your stop order? Oh, let's say you put your stop order at $1.44 out of the money, and you're going to get stopped out. Well, this spread stays alive. Okay, where you put your stop order, you buy the stock for $92.62, and you put your stop order in at $91. You get stopped out at $91. You go out and buy a $3 wide spread for $1.44. Guess what? You have 31 days to be profitable, win, lose, or draw. If you lose the $1.44, so be it. If you make some money, so be it. But utilizing spreads like this allows you to stay in the game, all right, when things are blowing up in your face, and that's what people always miss about trading in general. Anyway, with that, I'm going off on a tangent. I'm not a big advocate of like stops and stuff. Listen, you got to use stops if you're going to trade a lot, like intraday. If you're going to trade, hey, I think the futures are going down further. Absolutely use stops. Hey, I'm trading some currency products out there. Absolutely use stops. But if you just want to take a position in an underlying, like, hey, I'm bullish on TLT in the next couple of weeks, you got to forget about stops. You got to forget about buying individual options. It's ridiculous. It's got a low probability of success, and you have got to start to utilize vertical spreads, all right? Because basically, all you're doing to yourself as a trader in this business, if you go out and just buy calls, you're just hamstringing yourself. You basically came unequipped to be able to trade. I mean, you've limited yourself to like one tool where there's a lot more tools in the bag out there. Sorry, there's too many analogies to utilize here for this one, but I'm going off on a tangent. Anyway, with that, just looking over here, just reading a couple of questions. So anyway, give us a call, 877-927-6648. Usually this far into the talk, people are like, I'm scared to call. This guy is well caffeinated, and you'd be right. So just taking a look here, what's going on in the markets. Yeah, futures are selling off a little bit more here in the day. Again, I wouldn't be surprised if we tank towards the end of the day. Let's make a market here. Where do we think the ES futures are going to end up at the end of the day? I say we close down 34 handles. All right, so they're down 20 and change right now. I say we close down 34. We'll see. By the way, that is what we call just a blind guess at this thing. But again, it looks like order flow is actually pointing towards a pretty harsh close right now. Only time will tell, okay? Yeah, you know what? Somebody actually chatted in over here. Nickname is Trad or Trade, not really sure. Often get a second chance with options, okay? Go near worthless and unexpectedly rally later to profitability. It's right. I mean, creating spreads and option spreads allow you to stay in not necessarily great positions, right, and hold positions that are really not working for you, but with limited risk. I mean, that's what trading options is about. It's about being in a defined risk trade and holding that defined risk trade. I mean, that's why you put it on. Going out and buying stock or even buying an option and using a stop order, why'd you use a stop order? Because it defined your risk to some degree. And that's really ultimately what vertical spreads do as well. Yet the vertical spread doesn't stop you out of the trade, whereas, of course, using a stop order does, all right? So I can't tell you how many times I've had trades just blowing up in my face, when the vertical spread, only to be profitable later in that month. I mean, that's really what this is about. So we've got another caller here, and again, you guys can call us 877-927-6648. We've got Bill from Massachusetts. Bill, you there? Bill, you with us?
Yeah, I'm here.
All right. What do you got today?
I'm interested in an albatross.
Okay.
As opposed to a condor. What I want to do is I want to keep that profitability as wide as possible.
Okay.
Giving up some premium and giving up some the maximum gain on it.
All right.
How do you calculate how wide that's supposed to be?
Well, that's all on how much you really want to pay for it. Are you actually, when you say albatross, so albatross is like, it's a form of a butterfly or a form of a condor. It's calls with
yeah,
calls.
like a condor, except, a condor you're going to get, dollar, but the albatross you're going to spread it off of the center point.
Correct, exactly. So it's a form of a butterfly that's just widened way, way out. So I got to ask you, are you using this as a primary trade or are you using it as a hedge?
A primary trade.
Okay, all right. And that's the reason I'm asking that is, so a thing like forms of butterflies and even an albatross and all that really is a really widened out type, okay, of a butterfly which doesn't share a central strike. Ultimately, you're going to pay for that probability. So the albatross will probably give you a decent probability. So do you think we're going to move fairly large, though, one direction or the other? I mean, looking at this trade, it's almost as easy to go out and rather than do this, you could use something like an iron condor where you're selling out of the money premium. And I wouldn't say it's the inverse of it, but it's really, really similar. Okay, so are you also...
Well, you can set this up... you can set this up as a credit spread, too, whether you use an iron albatross or an iron condor or whatever it is.
Exactly. That's all I'm asking. I mean, it's what you want your probability to be. I mean, you can create them in the Russell with easily 85-90% probability of success, which is ultimately like selling a way out of the money iron condor. I'm just trying to ascertain what you're trying to specifically do with the trade itself, whether you think we're going to be range bound or whether you think we're going to explode one way or the other. That's what I was trying to kind of determine here.
Yeah, I wouldn't put this on now. This is way too scary. But once this all settles down again.
No, what's interesting about that is, when I look at selling premium, though, this is the time I look to sell premium. Like, I like the idea of an iron condor now because we've got slightly inflated implied vol out there.
Right, yeah.
The only thing is this could also be the calm before the storm.
Well, yeah, but that's why they call it trading.
Yeah. Only.
I just like the idea that you can set this thing up for, like, let's say on the SPY or something. For if the SPY is trading at I don't know where are we at now. It doesn't. But you can set
128 almost even.
Yeah, so you can set this up on a 10-point spread from 123 to 133 with the set it up today with the 128 in the middle, and that still gives you, you're going to take some money off the table. Especially if I'm kind of impatient, so I'd probably want to play the weeklies.
Oh, absolutely. Yeah, no, I actually agree with you. I agree with you totally on this spread. That's not a half bad way to go. Again, if you're not too directionally biased here, it's a trade. It really is. I mean, is there easier ways to do it? Well, no. I mean, what you're doing is fine. Again, basically what you're doing is just a version of an iron condor. I have tendency to use irons a little bit more, and here's my reasoning behind the iron condor is that, especially in the weeklies, the out-of-the-money options tend to price a little bit better than when you start to get to the in-the-money options. And I'm sure you've probably had some trouble getting some of your stuff filled from time to time. Even the spiders, those in-the-money weeklies are a little bit brutal. But, if you think we're going to stay fairly range-bound, there's a lot of traders today that also use types of diagonal spread. What they do is they'll sell, for instance, like an at-the-money strangle, for instance, in like a March weekly, and then they'll turn around and buy slightly out-of-the-money strangle, of course, in like the April option. So it's a form of like a double diagonal. You familiar with those at all? It's what you're mentioning. It's an albatross spread through 2 separate months, but it gives you more ability to sell those weekly options against long premium back in April. And it also kind of leaves you in a long volatility position. Pretty interesting trade. And that's stuff that you couldn't do without weeklies. Weeklies have really kind of opened up the door to that.
Yeah, what I've mostly been doing is just selling calendar spreads, buying the Junes, and just almost like a covered call, except instead of buying the stock or just buying a June and selling the premium against that.
Oh, absolutely. So you're actually buying the calendar spreads. You're buying a June, selling March, selling April, selling May into them. Absolutely.
Yeah, but I like the idea of the albatross. What I did was I looked it up and I used the risk profile in the TOS thing, and I get that nice long flat plateau that's like that's 10 points wide, and that's really exciting.
Yeah, absolutely. No, there's nothing wrong. Be careful again of those in-the-money options, especially in weeklies. If you're going to use puts, because they will pop you early on those in-the-money options if you do use them. Mm-hmm. Right? So keep that in mind, because that's something that's not displayed in the risk curve on ThinkorSwim in the Analyze tab. So again, also play around with the idea of the albatross versus the iron condor. It's a good idea to take a look at both of them. What you have to start to ascertain is the spiders do have early assignment risk, and if you've got an in-the-money put with little or no extrinsic premium, they're going to pop you early, and it's going to break your trade apart. That's just something to keep an eye on all the time when you're selling those in-the-money put options, especially. Also, if you've got in-the-money call options and there's a dividend payable, they'll hit you early and make you pay the dividend. So all things to keep in mind. Yeah.
What I did was I one more question on how to do this. What I did was I just put it all in a spreadsheet and tried to figure out what is the average move in a week for this, for whatever underlying.
I'll tell you what, we're going to talk about that next week in the show, and that's exactly what the market maker move is in there. On the top of your screen, we'll give you the move for a week, the move for a day. So, we're wrapping up here in just about 1 minute. And I'll tell you what, I'm going to talk about that. I'm writing it down right now. We're going to talk about it next week on the show. Is what's called market maker move to ascertain how far the stock can move in a given week to see whether it's a decent weekly trade on there. So sorry to cut you off here, Bill, but they're kind of wrapping me up here in the next minute or two. But thank you for calling in today, and I'm going to get to more of that next week. And also, feel free to shoot me an email anytime. The email is dkaufman, Kaufman, at thinkorswim.com, and I'll even take a look at your spreadsheet out there.
I did, but you weren't answering it, so I called you. Thanks for taking the time.
Definitely. I'll take a look at it. If I get it, I'll look at it, man.
All right. Have a good day, buddy. Bye-bye.
Thanks a lot. So, again, you guys can always shoot me an email, shooting questions, because I try to get as many of the questions as I can answered live on this show. Anyway, with that, futures are actually rallying a little bit. Again, pretty far off their lows of the day. We've about cut the losses in half. NASDAQ futures down 37. Of course, we see the VIX up about 3 today. Bonds are rallying pretty big. Got Netflix on fire up 16. Thank you guys for joining me today. I will be back next Tuesday, 1 p.m. Eastern Standard Time for the Options Hour. I'm Don Kaufman on behalf of TD Ameritrade and ThinkorSwim myself. Thank you guys very much for joining us today.